Craig, thank you so much for joining us today.
Hey, Elijah, this is fun. I usually do audio interviews. To do this video is kind of funky. I guess it was maybe about a year or two ago. I saw FBI Director Comey said nobody should sit with their camera uncovered when they're sitting at the computer, because you never know if the NSA, I mean, he was alluding to the NSA or the CIA might be watching. So I keep that thing covered all the time.
Wave hi to the NSA right here. But yeah, getting into the precious metal markets this week, just today, about 30,000 gold contracts were dumped on the market this morning. That's about $3.75 billion of paper gold. What is your perspective on how the precious metal market, or how the gold market, has reacted?
Well, we saw a spike up earlier this week too, and the metals markets, every market now is so dominated by high frequency trading algorithms that it's kind of hard to discern anymore whether something was done deliberately by the banks or whether it's just, an algo gone wild trying to run the stops one direction or the other. And you're kind of left with guesswork. Really, all we can do on this end when we try to figure out one versus the other is to look at where price was on a technical basis. And if there were any other, news items out there that would prompt these HFTs to suddenly take action and run stops, because a lot of the HFTs don't just act on their own. They're programmed to follow the dollar yen or the bond market or the VIX or whatever. And so, if you see a spike or a movement in the dollar yen and then all of a sudden you get this stop run, you can say, well, okay, well, that wasn't the cartel. That wasn't, the colluding traders of the JP Morgan or HSBC. Again, we've got the data now. We've got the smoking gun proof that that's exactly what they do. They collude and talk to each other in chat rooms and on text messages and stuff to try to massage price, would be a gentle way of putting it. So anyway, what happened today? It could have been just a stop run, but there wasn't a commensurate move at that particular time in the dollar yen or in the bond market, which leads me to think, this is just a standard old chart painting effort made by a collusive bunch of cartel bank traders. What I think they're trying to do, and we've been watching this at my site now for the last couple of weeks, is they're trying to break price down through the 200-day moving average in gold. I wrote, early last week, an article for the folks at Sprott. And in it, I was just trying to warn folks that this is a tried and true tactic. You bring price down as they have since early September, and you wash out a lot of the specs that are long. And if the specs are long, the banks are short. And so if they can wash out the spec longs, that selling by the specs is used by the cartel banks to buy back their shorts that they'd issued on the way up. Well, they've been reasonably successful in doing that as prices come down now $70 or $80 from those highs in early September, but they haven't really got it fully washed out yet. And what I showed in this article was that on the two previous occasions, just this year alone, by breaking the 200-day moving average, that is when you really got the specs to start just kind of indiscriminately dumping and repositioning themselves. When it happened back in April, it led to about a 35,000 contract change between the specs and the commercial banks. And then when it happened in June and July, it was almost 70,000, because moving down through the 200-day prompted a lot of those specs to go short even. So we started wondering if that wasn't coming again. We're poised right on it now as you and I speak on Friday afternoon. It's about 1268 in the December contract, and I think we're about 1269. And putting this all back together with what you originally asked me, Elijah, I think today's dump was, in fact, a cartel chart painting move, trying to smash price back down to get it to where they were going to close it right on or hopefully below for them the 200-day moving average. Mission accomplished, with the hope that maybe next week they can break it and get all that spec selling that we just discussed.
Definitely. And what have you been seeing this week happening also in the silver market?
Well, it's interesting in silver. We had this huge run. What was it, Wednesday? We were up 47 or 48 cents. That was actually hard to believe, maybe not so hard to believe. That day on silver, Wednesday, was the biggest one-day move in silver for all of 2017. That was our best day yet. Well, now we gave some back yesterday, and I think gave back almost all of that gain now today. So they just pulled it right back. Was that a stop run to the upside? Yeah, maybe. But at the same time, I think it was actually just a little mini short squeeze, because on Wednesday, all of the metals were going like crazy. I mean, it wasn't just silver. Copper was up more than 1%. Zinc was up big. Palladium was up big. Platinum was up big. I mean, you name it. And it was a big day for the industrial metals. Silver is basically an industrial metal at this point. I mean, nobody uses it monetarily, at least not at present. And so I think silver kind of caught a bid because of those other metals, just a general sector play. And then it kind of took on a life of its own, started squeezing some shorts, and suddenly it was up 48 cents. So it's nice to see. But I would imagine if the idea is to wash out some specs still in COMEX gold by dropping price down below 1260, maybe down toward 1240, then that'll help them wash out some specs in COMEX silver too. It doesn't have to happen. We've held the 200-day in COMEX gold now for, a couple of weeks. So maybe we can still continue to hold firm here. But it would not at all surprise me if there wasn't still some weakness ahead over the next week or two. A lot of support in gold, technical support in gold, down around 1240. So I really wouldn't get too concerned that, oh boy, here we go, unless that level was to fail, where we really start to break down in the low 1200s. Silver's got a lot of support too, below 1650. So at this point, it just is what it is. And I hope, Elijah, that we're still going to get a rally into year end. I've spoken with you. I mean, just about anybody that would listen through the course of this year. We've talked about what I call the generally accepted narrative for the year that was shoved down our throats after Trump won the election as justification for ramping the stock market. And we've thought all year that narrative would fail, and the price of gold would rise in kind of a 3 steps forward, 2 steps back pattern. It's been exactly right. I mean, there were a lot of folks a year ago thinking gold was going into the triple digits this year. And we said, no, that's not going to be the case. This narrative is going to fail and gold's going to rally. But we've also said that gold would see its highs for the year in the fourth quarter. Because I thought by then this narrative, everybody would accept that it has failed and we'd be rolling. As it turns out, it looks like the highs for the year may very well have been in the third quarter instead. So I'll have to wear that one. I thought we'd finish the year strong. We may still finish the year strong, and rally just as we've rallied the last couple of years after the rate hike. That might get front run a little bit this year. We might start to rally in a couple of weeks instead, but it can be hard to make new highs for the year from where we are now. I wouldn't rule it out, but I think it's probably likely I'll be wrong on that one, but that could still set us up for a reasonably good year moving into 18. Will be an unpredictable year, that's for sure.
All right. And one of the other things this week that came out was the jobs report. And I know you reported on this on your website, and you talked about how the labor force participation rate was way down. I think it was 1 million jobs. Correct me if I'm wrong, but
1 million people
left the labor force.
Yeah.
And also wage growth was a lot lower than expected.
Yeah, that's exactly right. And actually, the article I wrote this morning for my subscribers, I made public a couple hours ago. So if you want to grab it and link it to this metals wrap, yeah, feel free. Because again, I coined the term BLSBS. Gosh, not long after I came up with my own site. I mean, it's the Bureau of Labor Statistics BS. And it's picked up, picked apart, cherry-picked, if you will, by the financial media. You could go on the Drudge Report today, and it says, lowest unemployment rate since 2000, with a big smiley face as they try to cheerlead for Trump. But the only reason the unemployment rate went down is because nearly 1 million people were taken out of the labor force. And so you can lose jobs, but if you lose even more people that are, counted in your denominator, the unemployment rate actually goes down. And this gets to how the BLS computes things in the first place, because they remove you from the labor force and consider you not even in the labor force if you haven't had a job for a year. Well, okay, I guess that means you're not in the labor force, but what that means is they don't even count you anymore. I mean, they don't even factor you into their statistics. So that allows them to say, yeah, the unemployment rate's 4.1% when there's 96 million people that don't have a job. I mean, when there's, 140 million or something working age Americans, and yet there's whatever the 90 million some odd people of the 300 million that aren't in the labor force. How does that all line up to a 4% unemployment rate? But if you can roll that out there, if you can convince people, oh, things are great, well, then maybe people, want to mollify the masses. Well, things must be great. Maybe it's just me that's having such a tough time. I guess we won't grab our pitchforks and storm the barricades. But at the same time, you might also convince some people, well, things are great. Hey, I might even get a tax cut, so I'm going to go out and buy a new refrigerator this weekend. And that idea, that kind of wealth effect bastardization, they use that as kind of to get people to kind of this virtuous cycle pump the economy. But it's a scam, man. I mean, all they do is they pump the stock market. The richest of the rich continue to make money while the dollar gets devalued. They're constantly growing the money supply. And the vast majority of people, hell, Elijah, 2/3 of all Americans don't even have $500 in savings. And so they pump the money supply. The stock market goes up. The bankers and their clients all get rich. And the average people, you, me, and most of the people listening to this, end up just getting squeezed by rampant inflation and healthcare costs and education costs and everything else. And their taxes keep going up. Yeah, they're going to try to cut taxes at the federal level, but your state taxes go up, your property taxes go up, your sales taxes go up. It's a scam. And we're all just pawns being played by the bankers and their media. So anyway, it's a long answer. Obviously maybe not where you thought I was going to go with that. But this has been kind of a bird in my saddle all day.
So I guess there are two kind of ways that people could play this. You say it's a scam, that we're being told that the economy is all right, but in reality it's not. And one of the effects of, people having the perception that the economy is okay is we see the stock market just going to all-time highs, it seems like every day. Yeah. And so different ways people could play this. They could put their money in the stock market. They could ride the way and just, ride the lie, or they could get out of the system. What is your perspective on what's the best thing that people can do financially right now?
I think, when I first started this site was right at the end of the financial crisis. And I remember thinking at the time, oh, hell, we'll never get through 2010, right? Because all they did was paper everything over. I mean, the Fed bought all this garbage from their primary dealer banks, printed money to do it, and swapped them actual new money, good money, for all the garbage that they had in their balance sheets. It was basically going to be worth zero, all the mortgage obligations and the CDOs and all that other junk, right? So I thought, well, they can't just paper this over forever. And so I thought, how are they going to get through 2010? How are they going to get through 2011? Well, here we are in 2017. Now, I don't think it can go on forever. At TFMR, we always talk about the end of the great Keynesian experiment, the Keynesian experiment being this debt-based system where you just keep growing the money supply, just keep growing the debt. Well, we're already seeing that start to fail, and there's studies out there about $1 of new debt maybe produces 25 cents of GDP, if you want to measure it that way. And the servicing the debt is going exponential, right? I mean, we're now at $21 trillion almost, and another double will be 40 trillion. And so eventually the whole thing collapses. But I guess my epiphany was about 2014, maybe even 15. I remember about this time in 2015, I was really watching the stock market, and it was starting to roll over. And a lot of the long-term moving averages were starting to bearishly cross. And when that had happened in 1999, and when that had happened in 2007, it led to these dramatic drops in the stock market. And I wrote a whole bunch of stuff back then 2 years ago about how, boy, you better watch out. These lines cross. And every single one of those articles, though, every single one came with the caveat that said, in 1999 and 2007, we didn't have the central banks printing their currency from thin air and pumping things up. Hell, it just came out today. What's the Swiss National Bank now owns $88 billion worth of U.S. equities. I mean, they've just printed francs out of the blue, sold them, bought the dollar, and then bought $88 billion. The Swiss National Bank, historically the most conservative, safe haven place in the whole world. And they're buying Apple. So anyway, that corollary was always, we've never been in this kind of situation. When those lines have crossed in the past, things have gone down. But we're going to have to watch this time because this may be different because these central banks are doing everything they can to pump it up. And lo and behold, the lines began to cross, and all of a sudden, up we went instead. And so it was about that time that I finally just ran up the white flag and said, look, if you want to play around the stock market, knock yourself out. I mean, you're whistling past the graveyard. but it may keep going up 20% a year or more. I mean, look at what's gone on. I mean, what's the best performing stock market in the whole world this year? Wouldn't it in Venezuela? Right? The faster you print cash and pump it in, well, why the hell wouldn't the stock market go up? So if people want to play along, if they've got the assets to play along, if they've got the 401k, the IRA, whatever, go ahead. I think, you got to stay pretty nimble. And I definitely think, because all of this crisis is still out there pending, you better be stacking some physical gold and physical silver on a regular basis. And, the folks on my site that have continued to do that since 2012 are now getting to the point where their cost basis is about break even, because you keep buying it at, 14, 15, 16, 17. Eventually you average down far enough that you're about even. I know I am. So you got to keep buying the metal. No doubt about it. Got to go to SD Bullion and the other places and keep adding to your stack. But if you want to fiddle around the stock market with some pretty tight stops and pay attention on the daily basis in case the whole thing ever melts down, I mean, go ahead. Central banks are on your side. That's for sure.
Definitely. Well, Craig HEMKE, thank you so much for joining us today. I guess before we let you go, did you want to share with the viewers any last thoughts you had and where they can find you online?
Yeah, let's watch things again, especially over the next week or two. I'll invite you to. I'll send you that link, Elijah, so that you can post it with this about watching the 200-day moving average. Like I said, I wrote it about 10 days ago. I think that's something in a real short term people should be aware of. But we are so oversold by just about any measure, whether you follow the technicals or whatever. That again, with the strength that's under this market down around 1240 and 50 and 1650, 40 in silver, I think any extra weakness is probably short-lived. We then rally into next year. Then we've got a year next year that's going to be a lot like this was. Is the Fed going to hike? Maybe they're not going to hike. Is the economy slowing down? All that jazz. And it probably bodes well for the metals, to have a year next year, kind of like this year or 2016. So I just encourage people to keep the faith. Those problems are all still out there. We still got to prepare for the calamities that lie ahead that are coming at us from every single direction. My site is a bunch of people. I don't know what my subscriber base is these days, 1,400 people. We all see things about the same way. We're all there to help each other, provide information, provide links, stuff that we find through the day. And it's a nice play. It's a lot of people just, they're not there to complain. It's not a whole bunch of trolls that are bitter and angry about what has happened the last couple of years. We're all just mainly trying to look forward and help each other out. So I encourage people to check it out. It's just tfmetallsreport.com.
All right. Once again, Craig HEMKE, thank you so much for your time.